We will stay with China after the break and take a look at some recent changes in its IPO market. Do stay with CNBC as we continue our China coverage.
Challenged with the insurmountable, we will resolve to scale even greater heights.
Diversify your portfolio of investments, manage risks, expand opportunities.
Hi. Hello, Moto.
Scan, share, print and manage ideas. Whenever inspiration hits you. How well do you share? Rico.
Hit it.
Welcome back to Market Watch. Shares of China's Dynasty Fine Wine are up more than 42% in their market debut in Hong Kong today, following the lead of other recent successes from Chinese firms listing abroad. Well, earlier this week, China lifted a 5-month halt on IPOs and has changed the rules to make pricing more realistic. Well, for more on the changes, we're joined by Philip Chan, Research Director at Shenwan Securities, joining us live in our Hong Kong studios. Philip, thank you very much for joining us. We'll get onto the changes in pricing in just a moment, but I'm also just wanting to focus on the lifting of the halt on IPOs in light of the fact that there are already worries in the market about the creation of a glut of impending share offerings. What's your take on that?
I think it's something which you can label at the the China markets all the time, because there's always an impending glut. When one's interest gets starts up again in China IPOs, then a lot more issues come, and there are also always planned issues quite far ahead. I mean, the banks have been planning for a couple of years now, so I don't think there's any. You can't sort of say that there's an opportune time to list for China stocks, and like I said, the supply will always be great for new IPOs.
The supply will always be great. Will the demand also always be great, though?
Not always, no. It comes in and out. The demand, was very strong in late 2003, dropped off obviously in early 2004, picked up a little bit mid last year, and then it dropped off again. So I think the interest comes and goes, or is maybe not as strong and very strong. But I would say that the sustained interest that we've seen in China IPOs, say, over these last 2 or 3 years, has been longer than, say, you've had in previous periods. So it's a more sustainable interest, if you like.
Philip, it's Maura Fogarty here joining in. There's also the level of, sorting out the good IPOs from the not so attractive companies and sectors as well. Hong Kong today, we saw the debut of Dynasty Fine Wines, for example. Very good debut for this company. And it's in a very sort of enviable position of being in a market that people expect to do very well. What kinds of IPOs and in what sectors do you see strong investor interest still out there for?
Oh no, I mean it's quite clear that interest is still strong in, consumption products, consumption-related products, companies. That's why, for instance, the Linhua supermarket, when it IPO'd in almost a couple of years ago, was very, very well received. Dynasty Fine Wines is another one. Anything, like I said, to do with consumption is going to usually find quite good response. But that doesn't mean to say that basic industries have been forgotten about. I mean, the power industry, we had the Huadian issue last week, and that was quite well received. And other basic industries within China that are looking, companies that are looking to list, it's case-by-case basis, basically.
How do you explain, Philip, the decision by two of China's state-owned banks, Bank of China and China Construction Bank? In a report on Monday, it was announced that they're going to no longer seek their listings on the New York Stock Exchange and only list in Hong Kong. Is this purely because of stricter corporate governance rules over in the US, certainly after the collapse of Enron, stricter disclosure rules, or is there some concern there about investor appetite for them in the US?
I guess it's going to be a mixture of both. It's probably, yes, it's something to do, it will be to do with the corporate governance, the stricter corporate governance required, and the dual reporting times. But in the end, it doesn't really matter, whether they list in New York or in just keep the main listing in Hong Kong, because any sort of serious China investor who wants to buy the stock is going to be able to, will just go to any market. It doesn't really matter where it's listed. Yeah.
And we were speaking earlier on.
Yeah.
Oh, sorry, Philip. No, sorry. Finish your sentence.
No. I mean, so I think, what I was going to say was that the Hong Kong market with the H-share block and also a large block of non-H-share China stocks, I mean, it's a very solid market already with very good turnover. Foreign investors are quite happy to invest there if they need to find China stocks.
Also on Monday, we were speaking with Marshall Mays, one of our other regular guests, and he was saying that with the ongoing slight loosening of investment restrictions that were obviously put in place about April of last year, he says that there's a great need now to list as many state-owned enterprises as possible. Is that your idea as well?
Well, there may be a great need, but I think it's going to be, again, a question of balance. You see what the market can take, basically. I think what underwriters will do, I'm talking about the domestic markets, the pure Asian markets in China. It's really whatever the market can take. There's certainly interest in new issues, but the equity sentiment within the domestic markets is weaker than it is in Hong Kong. For different reasons. So, needs may be that state-owned enterprises need to list more quickly, but again, it's just a question on demand.
Indeed, and talking about weak market, the Shanghai Composite has been near 6-year lows. Philip, we have to leave it there, but thank you very much for joining us today. Philip Chan, Research Director at Shenwan Securities, live in our Hong Kong studios. Let's throw it back over to the Singapore Exchange now with a final check-in with Mark Laudy. Mark.